Lesson 1-3 goes on to working with transactions, and these are going to affect our owner's equity account. And we're going to take a look at how they affect our owner's equity in our accounting equation. Transaction 6. On January 10th, we received cash from sales. So you run your business so that you can make some sales, make some money. As you look at this transaction, it's going to affect at least two accounts. One being received cash. Our cash is going to go up by $1,100. Our sales is also going to go up by $1,100, the total amount of our sales. This chapter, we are going to throw our sales into our owner's equity account. So it's going to be one account there. Later on, we're going to split it up into the individual accounts that go under our capital account. So our total amount of sales is going to make our capital go up, and that is considered revenue. So our cash balance, we'll add that to our cash. Main Street service stays the same, supplies stays the same, prepaid insurance, and our accounts payable will stay the same. Our capital started out at $2,000. We made some money, so now our capital account is worth $3,100. And again, if we were to balance out the numbers from each side, we will see that our accounting equation is still balanced. Transactions affecting owner's equity. An increase in the equity resulting from a sale of goods or services is called a revenue. We just took a look at one of the transactions that dealt with that. A sale for which payment will be received at a later date is called a sale on account. Regardless, when payment is made, the revenue should be recorded at the time of the sale. This is our concept or our rule, realization of revenue. So we are going to sell some merchandise. It might be on account, but we might not get paid for that merchandise for a month or so. But what we are going to do is we are going to record that sale as soon as it happens. Not when we get the money, but when the sale happens. On January 12th, it says sold services on account to Main Street Services, $5,000. Sold services means that this is our type of sales. We are a proprietorship and a service business, so we're going to go out and do stuff for other people. Our accounts receivable account, Main Street Service, will be increased by $5,000. Accounts receivable falls under the asset category. And accounts receivable, what they are, is accounts that we're going to receive money from at a later date. So the amount's going to go up there. Our revenue, since we made money, is going to increase our capital account by $500. And again, we will write our balances. Main Street Service has a balance of $500. They owe your business $500. And again, you total these up and they should balance out. Your accounting equation should equal out. Unlike a liability, which is the amount that is owed, the cost of goods or services sold used to operate a business is called an expense. So, for example, the next transaction, January 12th, paid cash for communication bills for cell phone bill and internet service, $800. So on January 12th, you paid cash for communication bill for cell phone bill and internet service, $80. And again, you need the cell phone and the internet to run your business, so therefore it is an expense. Paying cash, your cash is going down by $80. Your revenue is going to also go down by $80 because this is an expense. Just like in your personal life, all of your expenses will make your cash go down. You figure out your new balances and they will look like this. And again, you balance out the left side and the right side. And you can see that those numbers equal out. Paid cash for equipment rental, another expense to your business. Paid cash, you're going to decrease your cash and you're going to decrease your owner's equity, which is your capital account, because an expense will decrease that account. Your new balance for all of your accounts will look like this. And again, you total up the left side and it should equal the right side. On the 16th, you received cash on account from Main Street Services, $200. Receiving cash will cause your cash to go up, so we will add $200 to our cash. Main Street Service, they owe you $500. They are paying you $200, so their account is going to go down by $200. When you figure out your balances, $1,655 is your cash. Now Main Street owes you $300 because they just paid you $200. And the rest of them get carried down and they remain the same. And again, when we add up our numbers, you can see that your left side of your accounting equation equals your right side. The last transaction we're going to take a look at, it says January 16th, Michael Delgado withdrew equity in the form of cash, $350. So as an owner, you can take out cash, you can take out any type of your assets, supplies and so forth. The only thing is you have to record it. So you have that right to take out assets out of your business. Okay, in this situation, he withdrew cash. So cash is going to go down by $350 because he took that balance out of there. Your capital account is also going to go down. Your capital account is worth less. He took money out of the business. And this $350 will be a withdrawal. And then you'll figure out your balances. Add your left side of your accounting equation and your right side. And they should balance out. Assets taken from the business for owner's personal use, again, are called withdrawals. And again, you can see that these will balance out. Summary of the changes of owner's equity. If you looked at your transactions, we had a couple of revenue. We had a cash revenue, and we had on account where we sold something on account and we sold it for cash. You can see that both of those transactions will increase your owner's equity because they are revenue. Your expenses, you had a phone bill and you had equipment rental. There are other types of expenses that your business will incur, but every time you have an expense, it's going to make your owner's equity go down. And then the other type of account the other type of transaction you had was withdrawal of equity. And in this situation, they took out cash, and that makes a withdrawal, makes your owner's equity go down. So after all of these transactions that happen, in reality, your owner's equity only went up by $770. Couple of audit your understanding before we move on. How is the owner's equity affected when cash is received from sales? The owner's equity is increased. How is the owner's equity affected when the services are sold on account? The owner's equity is also increased. How is the owner's equity affected when cash is paid for an expense? The owner's equity is decreased. How is the owner's equity affected when the owner withdraws cash? The owner's equity is decreased. Let's take a look at this little problem here. We'll go through it in class or online here. Here is your transaction. Receive cash from sales. Receiving cash from sales, again, that'll make your cash go up and your capital go up because it is revenue. The second one, sold services to Harman Company. Harman Company is going to go up because they owe you more money. And your capital account is going to go up because of the revenue. Paid cash for phone bill. Cash is going down. Capital is going down because that is an expense to your business. Receive cash on account. Cash is going up. Your Harmon company, your accounts receivable is going to go down because they owe you less money. Owner withdrew equity in the form of cash. Cash is going down. Your capital will also go down because it's a withdrawal. Your assignment is to complete under the end of the lesson tab for lesson 3-1. So here you have 3-1 in your online book. Under the end of lesson review, you will do the term review 1 through 3, audit your understanding, and there are 2 items under your working paper. You can complete those and submit them. Remember, even though it says counts towards grade, all of this practice will fall under your daily work in PowerSchool.